And we are live. Sorry for being late, about 8 minutes late. I have Jim Black, who's a good friend of mine for, 30 years. He's been a loan officer for over a decade. I want to say probably 2 decades. He's going to be joining us once he gets his technical difficulties all sorted out. But yeah, just wanted to hop on here and answer any questions for you guys. I feel like I've been kind of MIA in the comment section because it's really challenging to get back to everyone. But I wanted to do this live stream because you guys voted for it. You guys wanted to do more a live stream, and so I'm available to answer any questions you guys have about the housing market. Maybe you guys have a particular question you guys want to answer as well. So happy to do that. So thanks so much for joining in. What we have here, Jay, 2.5% rate. I mean, that's an awesome rate. I have a 2.625 30-year fix, and this is exactly why we have a lack of people selling their houses, right? So yeah, very, very low rate. Same with Ninja, 2.5%. You guys have awesome rates. You guys must have refied back in, I'm guessing, August 2021. Let me know if I'm right or not. Yeah, Jay's exactly right. There's no inventory coming to see the buyers. The people with homes have historically low rates. Yeah, Redfin just reported, was it a couple of days ago, how new listings were down 23% compared to 1 year ago. The biggest drop, excluding the onset of COVID back in April 2020. Obviously, there's a big decrease of new listings then, but yeah, it's pretty remarkable. And it's frankly sad because we need a lot of inventory to give buyers options, but also to decrease prices as well, because housing affordability is like super, super low, at or near all-time record lows, which is really sad. Kevin, how are you doing? Longtime subscriber to the channel. Hope you're doing well. Thanks for joining in. If you guys have any questions, and by the way, I'm going to save this video on the channel. So if you're not watching this video on the 23rd of May, this is a live stream. So if you have any questions, you can always comment after this video is posted. I'll be live for about 45 minutes to an hour with Jim Black. And Jim Black, again, is a loan officer, been a loan officer for a very, very long time. So I thought it'd be good to have him on the channel to discuss any of your lending questions, since I'm definitely not the guy for that. So I'll add Jim once he's on here. Anthony, how's it going, man? Good to see you. Good afternoon. Or what's this? Real estate mindset. Good to see you. Thanks for the donation. $10. Appreciate that. I'll go get a burrito. I love burritos. Anyways, thanks for joining me. Real estate mindset. Appreciate you. Let me see if I can get Jim on the stream here. Jim, is he alive?
I'm Jimmy. Trying to be.
Okay. I'll get back to you in a little bit here.
Thanks. Thank you.
There we go. Yeah, again, thanks for the donation. Appreciate that. What else we have? Here's Mike. Lakeland, Florida. I wonder what the market's going on there. I need rates to lower so I can buy a bigger place. Yeah, that's a big, big problem, right? Like someone to sell their house and buy the same price home they sell it for, their housing payments can absolutely skyrocket. I did the math in mind. If I was going to sell my home, buy a new house, buy the exact same price home that I can sell my home for, my housing payment would more than double. So people that move up buyer looking to sell their house, buy a bigger house, maybe in bigger neighborhood, a bigger backyard. It's really challenging because, why would you sell your home when you have a 3% rate and move to a new rate of 7%? So just to give you guys an update on rates, let me see if I can share my screen and briefly show you guys that. So I hope you guys can see my screen right here, So average rates today, I just made a video about this today. It'll be posted probably tomorrow morning. So average rates, according to the Morris News Daily, 7.01%, absolutely insane. 15-year fix, 6.3%. FHA and VA around 6.6%. Absolutely insane, because these are the highest rates we've had going back to the beginning of March. So the beginning of March, right here at March 8th, average rates are at 7.05%. Now, again, they have increased to 7.01%. 1 year ago, rates are at 5.36%. That's a giant increase of 1.65 percentage points over the last 12 months. And also, rates have increased greatly ever since the beginning of April as well, going from 6.16 now to 7%. Just absolutely crazy. So that's that. Let's see if Jimbo is on the line here.
Hey, Jason.
All right, Jim.
Can you hear me okay? Thank you for your time. Some technical
No worries at all. No worries at all. We'll take it out of your commissions, your future
Please
commissions.
do. Yes. Thanks, guys. Thank you for everyone. And I'm excited to be on your show here, and excited to share some information and answer some questions. So
yeah,
thanks
absolutely.
for having me on.
Absolutely. Thanks for, let me switch our places here. Yeah, thanks for joining, Jimmy. I know you had some technical issues. No worries at all.
Sorry about
just
that,
answering some questions. I'm sure that people have some questions for you, since I am not a real estate loan officer. Steve-O, thanks for joining. Steve-O is always number one in the comment section every single video post. Even if I do a double header, he's always there. So I appreciate you, man. So Jim, since you are here, I've known you for 30 years, something like that. Probably about 30 years.
I think,
pretty amazing. Yeah, maybe more than that,
I think actually 20. Yeah, I think like 30 years, 2 months, 10 days, and I think 6 hours to be exact. So
a couple hours.
Yeah.
Yeah, who's counting? Who's counting? Yeah.
Yeah, exactly.
There must be an app for that.
That's good. Actually,
but Jim, I mean, I had you on the channel once before talking about the latest and greatest regarding lending. For those who missed that video, if you would be so kind to introduce yourself, who you are, what do you do?
Sure. My name's Jim Black. Very nice to meet everyone on the call and in the recording. I'm a passionate loan officer. I've helped over 8,400 families with the dream of homeownership. I help families create wealth through real estate financing, and I've been doing this now for 22 years. So never a dull moment. It's when you have a passion for something, every day is exciting. So I'm always excited to talk to people about their scenarios and their goals and help them achieve those goals. So never a dull moment in real estate, as we all know. But lending's had its challenges, and its rates have gone up dramatically, as we've talked about before. But I would love to share some insight, and feel free to ask me any questions. So.
Awesome. I can't believe it's been 22 years already. That's amazing. Time flies, man. It's crazy.
Yeah, absolutely.
So I do want to talk about like the LLPAs, those adjustments for the credit and everything. Maybe we can answer some questions. It's a little bit late here. I want to answer some questions that we already have in the chat here.
Sure.
So maybe we can do that first, and then talk about these changes, these loan level adjustments based on credit, your credit score, and also the debt to income. But this gentleman here has a question for you. Where do you think rates are headed? So luckily I do have you. I'm gonna turn on my light here, but go ahead and answer.
Sounds good. Sounds good. Thank you for the questions. And again, thank you for your patience today with me on the call. So what we've seen in the last year and a half, rates have gone up dramatically to spur inflation concerns with the Fed. The Fed opinion, which is an important part of where the market's going and how the markets react before they make changes, has signaled that there possibly is 1 or 2 more Fed increases this year. That would potentially make rates go higher for short-term debt instruments, things like credit cards, things like lines of credit, anything that has a variable index relative to the federal funds rate, which is the index that the Fed can control to loosen or tightening spending or confidence in the consumer's borrowing or saving money. As interest rates go higher, borrowers are more likely not to spend money, but to save money, which then contracts the inflation concerns. So I believe we'll see rates go up for the next couple months. I believe they'll be going up, or I would say up means like an eighth or a quarter higher in rate in the next 2-3 months. I do believe that the economic indicators towards the end of the year will show that we're starting to go down on inflation or towards a recession. How deep, I don't know, But that sentiment will change the mindset of the Fed presidents who manage different parts of the country to decide on if they're going to raise rates or not. That sentiment from the government will play a role in how the markets react and how bondholders and traders will trade mortgage-backed securities, which is what we have for long-term debt. So I would say we're going to see an increase of an 1/8 to 1/4 in the next couple of months, with very low inventory, which is another concern with housing, which will probably allow people that buy in the next few months to be able to have a benefit next year with rates possibly going lower. So those people that buy at a higher rate could potentially refinance next year. I do believe rates are going to go down about 1% in the next 12 months.
Wow, 1%. So down to like 6%. Wow. Okay.
Exactly. I think we'll be going back there. And again, remember a really simple rule of thumb that I think you shared, Jason, on your show also. 1% difference in rate is a difference in buying power of about 11 to 12%. So if you're buying now while other people are holding off, you're going to have an advantage potentially down the road when you go to refinance, because when you have a lower payment and a higher buying capacity, those same buyers that have been on the sidelines will be competing for higher priced properties because everyone can afford to buy at a higher price. Does that make sense, that question or that answer?
It makes sense to me. I mean, the issue with people waiting is that when you have prices go down and then rates go down, that tends to increase demand, which causes prices to go up. So it's really hard to time the market, right? And so I always tell people, buy when it's right for you, because it can be really challenging to time the market. One thing that you did say that caught my attention was, and in Orlando, good to see you, buddy. Thanks very much for the donation. Appreciate you.
Very kind.
One thing,
thanks,
yeah, one thing you did say is that did you say that the Fed is going to be increasing the federal funds rate 2 more times this year? Is that what you just said?
There were talks about it today about the Fed raising the rate potentially 2 more times, 1/4 each. Some banks and large banks want them raised even higher, because if banks raise them even higher, more banks will go out of business, and those banks that survive will have a higher level of market share and less competition, which means potentially more profit for them. So it's interesting to look at this through a lot of different lenses, right? From a competitive perspective, banks that are healthy, that are in good positions, the large banks that are stable banks you see on every corner, they want inflation to be controlled, and so they're willing to take the higher rate risk quicker. That same rate risk for smaller regional banks or credit unions is more painful because they've leveraged or hedged their risk on lower interest rates. So as rates go higher for these smaller companies, their cost of capital goes higher, and then they have to sell off assets. So it's not a good thing for banks. But for us as consumers, we want the pain to be over as soon as possible. We don't, it's really hard. If you think about the retiree, the baby boomer who's on a fixed income, every little increase in fixed expense is not good against fixed income, right? That hurts their well-being. And that's the worst thing we do to those people that have worked hard their entire life to save up for retirement, to get their Social Security, to try to budget 20 years ago for their payments today. So those are the people that are most affected. Also with our first-time home buyers and people that are maybe on the sidelines because their payment shock has gone up so much with rates going higher. So it affects a lot of groups differently, but the overall theme from where I sit is we need to get rates lower, because that will spur more confidence for people to feel comfortable making large decisions. And like you kind of mentioned earlier, if you make a good long decision today, if you look 10 years down the road, that decision should still be the same good decision you're making. So people should not play the market in the short run right now. They should look long run and see that they're making a good decision for their families. And, owning a property as a long-term investment, not just something that they can flip in a year or two, because that game is over. The flipping of properties is a very hard game to be in right now because of the cost of capital and the cost of increased construction costs and labor costs.
Yeah, absolutely. Having gone through a remodel a year ago, I can attest to that. So it's like insane how
Definitely.
expensive it is nowadays. So when you
Absolutely.
mentioned about the Fed potentially raising rates twice more this year, you mentioned the banks wanting, or the larger banks wanting this. I get that if they want to, have more bank failures so they can buy banks at a discount, have a greater market share. But isn't the increase of the federal funds rate by the Fed, isn't the primary reason for that to control inflation and not to, you know, aid in creating fewer banks in the US?
Yeah, it definitely is. So when we think of the Fed's role, they're trying to take the average Joe in the United States, wherever they may live, and make sure that the effects that they put into place with monetary and physical policy don't affect the masses of those people. Remember, the average mortgage size in the United States is like $300,000. The average value of a property is something like $450,000.
Hmm.
So they're really wanting to be sensitive around people that are on more fixed incomes or middle income type of borrowers that make up most of the United States, not the
Mhm.
people that are on the coasts in California or on the East Coast, but the people really that make up the majority of consumption in the United States, those people that really drive the economy, the small business people, those kind of things. So,
Okay, makes sense. All right, thanks, Jimmy. I'm gonna call you Jim since this is a
yeah, it's
professional.
fine. No, no problem.
uh,
Whatever you want to call me.
all right,
Jimmy's when I'm in trouble. So I'm a little in trouble because of the.
Jimmy, yeah, I like your mom
Yeah.
said.
Okay. All right.
Jim and I have known each other for a long time. There's 138 people watching, so thank you to
Thank you
everyone
guys.
for
Appreciate
tuning
everyone.
in. I appreciate your time. The last time I did a live stream was back in September. So if you guys want to see more live streams with Jim, other loan officers, anyone else, let me know, or just by myself, let me know, because I haven't done a live stream in a very long time. So this is fun. All right, Manny, would you consider an ADU a great value add as a realtor? I would say the costs of construction are so insanely high now, unless you can do it yourself, like you're a contractor yourself, you're probably not going to get back the value in how much you pay for the ADU. Having in California, I talked to my general contractor. I can't remember what he said. It was like, hundreds of thousands of dollars, like well over $100,000 to add like 500 square feet. So if you're talking about an ADU where you're going to build it, you put in the slab or a foundation, electrical, potential sewer line. If you have a bathroom in there, it can be very, very expensive. And so I would kind of go back to, what's your goals of having the ADU? Is it going to be because you really just want to add value to your home? Not a good investment in this place, because the construction costs are so high. You also have a market where the housing market's been softening as well. So I would go back to what's your goals of having the ADU. There's other things you can do, like you can get a manufactured unit. Maybe Jim, you can talk about that too, because you can get things that would be cheaper, like what do you call them, prefab ADU. You can get
Yeah,
a Costco or
modular
whatever.
prefab one. I
Yeah.
have, ironically, two of them in my house. One I did get from Costco that was a higher end company out of Colorado. And then recently, at the end of last year, I actually ordered one on Amazon using my credit card points for my business. And maybe we'll have those photos be posted at a later time, but they both were different quality of construction and they have different purposes. And so back to your point, Jason, it is about the objectives of the homeowner. If you need more space and you need an office at home, then the cost might be worth it. If you have more space for your kids to have a place to play and it's a safety thing, then it's priceless, right? We all have different objectives. So looking at it from a perspective of cost versus value, you just have to make your own kind of T chart to determine what they are and lay those out for you. And whatever you're doing, still think of the long run when you're making those decisions. And if you do that, it'll kind of make that decision make an obvious yes or no answer for you.
Yeah, it's a really good point. I would say that it depends on how long also you're planning to live in the house too, because there's a lot of people like myself and Jim who have low rates, and so you're really have low motivation to sell. And so if you're in that scenario where like, I need more space, but I'm not going to sell my home and I want to buy a bigger home, that really doesn't make a whole lot of sense based on today's rates. So yeah, it really depends on your situation and what your goals are.
And there
Very
are
well
there
said.
are lines of credits that are available. There are ways to get financing, it's an important part of it all. So just know we have the ability to get financing on these a lot of times. So again, work with your favorite local professional that can help guide you in the right direction to make sure that, cost is worth the value for you. So,
Yeah, absolutely. Sandeep has a good question of why, I assume, why did new home sales rise and the price is increasing? I actually just made a video about this today as well. It'll be posted probably tomorrow as well. So this is I assume you're talking about the U.S. Census Bureau, which just announced on this morning, actually, that new home sales actually increased. I think it was like 4% month over month, a gain of like 10% or 11% compared to a year ago. And the reason for that is that, in my personal opinion, is that we have a lack of houses for sale for existing houses, older houses, historically speaking, down by about 54% compared to pre-pandemic levels back in 2019. Even though we have far more compared to the past couple of years. So we have this lack of inventory for resale. And then you have this glut of new home construction in which builders really have to get rid of their new homes they're trying to sell. And so they're doing that by decreasing prices, offering incentives that you really can't get in the resale market. And so, in my personal opinion, a lot of people are moving towards new home construction because of that.
also, I would say too, a simple stat came out today from association data. We have had the lowest level of inventory available. We've had the same level of inventory as in 2010. So that's pretty important to think about, right? So again, in 13 years of building properties, of having more units be put on the market, we have the same amount of inventory available today as 13 years ago, which just tells you there's not a lot of supply available. And builders, when they see costs go higher and their costs to build and their projection is 18 to 24 months out, they get a little bit skeptical also when the payment shock of higher interest rates plays a role, and just the unknowns of the economy, the economic kind of forecast in the market. So you have a lot of people in a holding pattern right now in certain parts of the country that aren't going to be aggressively building. So less supply and the same pent up demand does not mean, means houses are going to go higher in costs. So.
Yeah, absolutely. The lack of inventory, lack of new listings is a giant, giant problem. I talk about this on the channel all the time. Laura has a good question. What's your take on second home, vacation home market? We are seeing less sales and rising inventory. I just did a collaboration with Jeremy Knight, Austin, Texas agent there. He said they're seeing a lot of vacant properties. A lot of investors are selling their properties there because they're seeing property tax bills increase by 50% in 1 year. That's absolutely insane. Whereas in California, we have a cap on the increase of our tax assessed value. So if our home is worth 700,000, it only can go up by 2%, and then they tax it based on that new basis. So we have a cap in California, which they do not have in Texas. So in a roundabout way, it varies by the market, but I would say that the second home vacation houses, back in 2020, 2021, when rates were at 3%, it's very, very cheap money if you want to buy an investment property, and especially a lot of people Airbnb back then as well. So that's kind of like been dried up because rates increased so much. Anything you want to add on that?
Yeah, Laura, there's another factor there too. The first homes that get hit, if there's a shift in the market or increase in costs where people are starting to get more conservative in their investment style, second homes go first, right? So second homes are the least affordable compared to an investment property that brings in income. So you're going to start to see some seasonality there factor into second homes, especially if it's in a heavy storm area or wet, snow area. A lot of those properties, they don't put the homes on the markets those times of the year. So you are seeing an increase in inventory, and interest rates being, in the mid 7s for second homes also don't make them as affordable. So a lot of times people are going to probably focus, if they're going to buy another property, on an investment property or an Airbnb property.
Yeah, absolutely. Moses has a good question as well. And thank you everyone for joining. I really appreciate your guys' time. Can I put a mobile home in my yard and rent them out? I have about an acre and I can fit a few mobile homes. Is that legal? It varies by the area, but maybe Jim, you have some insight on that.
Yeah, so it depends where you are. California has gotten very aggressive on allowing flexibility on creating more housing units. The California is still about 1 million units short of their goal of having, having more housing. So a lot of the flexibility we've seen comes from the state level, which then goes down to the county level, the city level, and then even the neighborhood level. So check with your local county first,
Yeah.
and see what those restrictions are. You want to know what the zoning is. That's the actual definition. So get the zoning and learn about those ADU units and what an ADU means in your area. Is a mobile home an ADU? It just depends on the definition of your specific jurisdiction that you're in.
Yeah, it's good. Good answer. So they would contact the local building department in their county, right?
Yes, that would be that's where I'd start. And then,
Perfect.
yeah.
Okay, awesome. Curious observer. Hello, San Antonio, Texas. Maui. I wish I was in Maui right now. Man.
Aloha.
Jim, maybe we should move this live stream next month to Maui. That'd be awesome. We hang out with DV.
I would like that. That's cool.
All right, Justin, that was a good question. What's the reason for the recent mortgage rate hike? Is this a counter to early spring predictions? This is a great one for Jim.
Yeah, great question, Justin. So again, remember sometimes financial markets and mortgage rates are shifting upon forecasts. So what's happened with the uncertainty of a lot of the federal issues right now, for example, at the end of this month, it's a huge date on balancing the budget or putting a proposal together. That's creating some strain on our credit quality of the United States Treasury. So what you'll find is that other countries, as each day goes by closer to that really important deadline that we have to meet, our credit quality goes down and down, which means it's more risky for those investors to basically buy the US dollar. So you're seeing a little bit of increase in rates for that factor, but also just the fact that inflation is still not under control. Housing employment data is still not very bad yet. There are less losses than we thought we'd have for employee losses in terms of people not being employed, unemployment. So I think those factors were all built in to having those things happen, and they haven't yet. So that's why you're seeing rates continue to go higher. We are seeing signs of weakness, but not enough signs of weakness to change the market conditions.
Yeah. Yeah. I think they will have elevated rates for a little bit here for sure. Hello. Hello. Nice to see you here. Oh, Pacifica. All right. Awesome. I rode my bike through Pacifica one time. Good to see you, Crystal. She's a longtime subscriber of the channel as well. Thank you for joining in. Aaron says interest rates at 10%.
Yeah, no, they won't go that high. They won't go that high.
Well, I think there's a lot of, what's that?
If they go that high, let's say we're at 7 today, right? If we go up 3% from today, wipe out about 36% of affordability. That would put pretty much anyone who's bought a home in the last 10 years underwater. So yeah. I don't think it's going to happen.
Yeah.
But good. It's a good thought. But I will tell you what will happen. People that have a home, like baby boomers that are retired or empty nesters, if they have a low interest rate, they may think about renting out their property versus selling it when they go to move somewhere else. Mm-hmm. So you might find some people holding on to their properties as investments purely because their rate is so much lower on that asset versus what it is today for that same asset class. So you may see people decide to hold on to their property and rent out, even if it's a little bit of a loss, because that's a better investment than potentially buying something else at a higher interest rate. So very interesting things happening right now. And it's that mindset of, can I buy before I sell? People are stuck in their homes right now. They don't want to move unless they've found that next place they're going to move to. So it's a really big phenomenon that's going to be here for a few years, I believe.
Yeah, I know. I mean, we haven't seen the rates at 3%. And then for such a long period of time, it wasn't like 1 month. It was like the entire year for 2020, 2021, practically. It was absolutely insane. I did the math on my house. If I was to sell my home, if I was to rent out my house, I'd probably get double my housing payment. But where am I going to move to? It's really a tricky situation.
You must have a great loan officer you work with. I don't know who that is.
Jim Black, FYI. This is not a paid promotion, but he did my refi.
Anyways, no promotional plugs. Sorry.
Yeah, I always tell people I have my 2.6% rate, but thanks, Jimmy, for that. Anthony has a good question. Is there any workaround to keeping a seller's conventional loans interest rate when buying a home? I think you mean like assuming they're financing. That's not something we simply see in my area, but what do you say about that, Jim?
Yeah, so they're assumable loans. Assumable means that you can take over the current balance and rate of that loan, not what it originally was. A lot of assumable loans went away about 10 years ago. So FHA loans used to be assumable. Credit union type of loans used to be assumable. VA loans are still assumable. But again, if you're buying someone that has an assumable loan and they've had the property for 10 or 15 years, that loan balance is relatively low, and you're going to have to bring in the difference to be able to assume that loan. So if someone bought a house for $300,000 and had a loan of $200,000 10 years ago, that balance is probably $100,000. And we know that that value 10 years ago has gone up probably double or triple. So that gap of the difference in the assumable loan balance relative to the down payment you have to bring probably doesn't make it feasible for a lot of those assumable loans.
So to bring that money cash, then you're saying.
Exactly, because you get to assume that loan in first position, and a lot of times you cannot get a second loan behind that. So,
interesting. Yeah,
that's
that
a good
makes
question.
perfect sense.
Yeah, so veterans have assumable loans. If you're a veteran, you can potentially assume another veteran's loan. So that's a really good benefit for those people that protect our freedoms. So thank you to all the veterans. If they're already on the call, appreciate you guys and all you do for our country.
Absolutely. So that'd make more sense, it seems like, for someone who more recently bought a house then, because the values have not skyrocketed. Obviously, it would make sense for someone who bought a house 10 years ago. They only owe 100,000, but they're trying to sell it for 900,000. Who's going to bring in $800,000 in cash? So
exactly. And that's why those loans, and most of those assumable loans they've been kind of shelved for about 10 years. So we don't see a lot of assumable loans in today's market.
Okay. Maybe this would be a good time. I'll get back to some questions here soon. But maybe this would be a good time to kind of talk about the confusion around these loan level price adjustments. You have a high credit score versus low credit score. Your payment or your adjustment, your payment you pay up front just went up if you have a high credit score versus a bad credit score. There's some changes too with the DTI. Maybe briefly, if you kind of share what's going on there, because I was even confused about this as well, especially since there's like a bunch of things happening and some changes as well.
Sure. So the government is always going to try to allow every citizen the right to buy a home. It's the American dream, right? To buy a property. The government can regulate that on the things that they can control. So they control FHA and other government entity backed or supported loan programs. So they only have a few tools in their chest that they can use that allow them, on their tool belt, to help give first-time homebuyers a better opportunity. In their data collection, they determined that the lower income and lower credit score class of borrowers were not getting treated fairly when they went to write offers. They thought a good solution would be to remove those risk-based adjustments to a lower credit score and less down payment. So again, if you think about it from a perspective of investing your own money, which I always do when I help somebody, I want to make sure I'm helping them and make a good decision. If someone has less down payment, so the bank or the lender owns more of the property, and your credit score is lower, which means normally there's a higher likelihood of a default or not making your payment, the government in the last 3 months was proposing that they should get better pricing for that profile than someone who has a higher credit score and more down payment. Very backwards thinking, right? So again, if you have a lower credit score and less equity in a property, it should mean that it's a higher riskier loan. If you go into default, the bank has more risk versus that borrower who put down 50% and has a higher credit score and a history of probably making their payments on time more often. So the LLPAs, or loan level price adjustments, were towards the tiers of lowest down payment and lowest credit score. Some of the other things out there I saw on Instagram and other social media sites was educating people on how to lower their credit score to get better interest rates.
Oh my gosh.
That's crazy. Like, Jason, you should really be late on a payment on your credit card because, you're going to get a really high interest rate by having good credit. So let's help you destroy your credit and have a higher riskier profile that will give you better rates and lower costs. So it backfired dramatically. The investors of these pools of money thought it was the biggest mistake that the government's made. A lot of lobbyists in my industry helped fight to get that removed. Not saying that we shouldn't have first-time homebuyer products. We should have a lot of unique things that are offered for certain profiles of life event people that have things that happen. But to have that be the statement to negatively affect people that have better scores and more down payment was not a good outcome. So long story short, those have been removed back to normal. There are adjustments in general for lower scores and lower down payment, but there are tons of first-time homebuyer products that exist in each state, each county, each city. Sometimes even your employer may have a first-time homebuyer benefit that you're not aware of. So, talk to your favorite professional to make sure that you're really identifying the right need for you. And it might be the state of California helping out with something versus the federal government. It might be a local grant in your community or some measure that was passed in your tax bill locally that gives you a better benefit. So really work locally. And I'm lucky I'm licensed in 31 states. So that's a lot of things to remember. But, again, just start there and see what's available if you're in those buckets of first-time home buyers.
That's awesome. I'll leave your info in the description below too.
That's cool. No
after
problem.
the video too.
As long as they don't call me Jimmy, then we're good. So I'm fine.
All right. Thanks, Jimmy. Appreciate it.
it.
Thanks for that. And maybe we can make if there's more questions regarding these loan level price adjustments, maybe we can make a separate video, perhaps, because I think there's still, there could be some confusion, especially there's videos out there telling about how the best way to ruin your credit score so you can buy a house for cheaper, right? Like, seriously, does that make any sense?
Yeah. This is actually a good question. Aaron has a good question. That's a really nice
thanks for the question, Aaron.
Yeah, awesome. So Aaron's question is around, he's waiting for a home to be finished in Tampa Bay in Florida. It's going to be done in October, which probably means late October or early November. Just be aware of that. So you can get what's called a builder extension lock. So most locks you can get or forward commitments on rates, which means you're locking in the rate before you own the property and before with it, normally it's a 30-day period, but this is a longer period. You can lock in your rate with the builder extension program, and that allows you to have up to 180 days protected under a rate lock. What that means is your rate can't go higher in that 180 days. There's probably an upfront fee that's associated with getting a lock. And then normally at the end, once you have final approval and your project's almost done, if rates have gotten better, you get one free float down. And a float down means you can get a better rate one time for free from that same lender that you're locked in with. So that's called basically a long-term lock or a forward commitment. They're offered throughout the country. They're offered for VA. It's a really important thing to look for. So again, if you're in a longer escrow, and the escrow is basically normally 30 to 60 days anywhere in the country. If you're in a longer escrow than that, ask your lender if you can get an extension or pay for a forward commitment lock. So that's an important thing.
Yeah. The other thing on that too is hard to know when to actually lock in your rate too. It's always a challenging thing to try to figure that out as well.
Yep. And always focus on payment versus rate. People can get caught up on this rate thing so much. And if you're comfortable with the payment and you're comfortable living in this property for the things you enjoy about it, sometimes that's as far as you should focus every day. And then if rates get better, fantastic, that's a bonus. But just the mindset, I believe, should really be about, can I afford my payment? Am I going to love where I live? And do I see myself there for the long run? And if you have those three things that say yes to that, to those answers, then I would definitely not worry so much about the rate.
Awesome. All right. And John has a good question, some good photos of some cars as well. I'm a buyer in New Bern, North Carolina area, 650 to 850,000. currently appreciated. Homes appreciated 200,000 in 2 years. Wow, 100,000 per year. That's amazing. I'm concerned if I buy now, I'll take a substantial depreciation hit. Should I wait? When everyone asks me this question, should I buy or wait? I always tell them have long-term time horizons in which you plan not to sell a home 7 to 10 plus years, have a stable job, also have an emergency set up, emergency fund, I should say, in which you have your monthly expenses 6 times that. So 6 times your monthly expenses, ideally an emergency fund that you're not going to touch. If you have all those things in place, then you find a beautiful home you like, then, why not? I'm not in the place to tell people now is a great time to buy or now is a horrible time to buy. It's a personal decision.
And John, one more thing there, just a simple rule of thumb always to think about is how much of your gross income, which is your before tax income, you're making towards monthly expenses relative to saving for like a 401k or retirement account or other things. So the good rule of thumb is about a third of your gross income would be a good amount of payment to have on your housing payment. Some of the lending guidelines will go up to 55% of your gross income for your housing payment. And that's a big mistake for a lot of people is that you're going to put 55% of your before tax income into a payment, which is not a good decision. So just think about that and look at and decipher that for you. And again, if things are going to depreciate, chances are good the rates will go lower. So that difference in overall payment may go lower for you if houses were to depreciate also. And so it's just important to be aware of. And like Jason said, think 7 to 10 years out. And I was in Asheville in the Carolinas a couple weeks ago. That's a beautiful place. So New Bern's a very, very nice place. So congratulations. And it's exciting to be buying a house right now. So
I've been in Nashville as well. Asheville's cool. I wasn't there 2 weeks ago. That's awesome. A long time ago when I was there. Gregory has a good question. I don't know if we call ourselves fine gentlemen. I know Jim does. He calls himself fine gentleman all the time. Mine's not Jim. It's fine gentleman. We are finally on the brink of a significant home price reductions. Oh, are we finally on the brink of significant home price reductions? Significantly looking at so price reductions. It's crazy. Like looking at national level. Back in, I think it was like late November on a national level, looking at data from like altosresearch.com, it was like 44%, around 45% of all the houses that were for sale had price reductions. Now it's only 30%. And it's been pegged around 30% for about a month or so. So we're not seeing this giant decrease in our market like we did in the second half last year, especially regarding price reductions. I don't know exactly about Sonoma County, though. You might be seeing something different there. Do you have any insight about Sonoma County, Jim?
I always get concerned personally. So I live really close to you, Gregory. I live in Santa Cruz, California, in a town called Aptos, which is on the coast, and there's a lack of land. There's not a lot of building that can be done, right? So it's pretty safe where I live in terms of knowing there's not going to be big builders coming in, a lot of inventory coming in. But in areas like Sonoma or areas that have a lot of land around, you have a propensity to have people more focused on building in those areas because land might be a little cheaper than trying to build in San Francisco, for example, or LA or whatever big metropolitan area. I would say that I agree that the second home market is going to soften. That a few comments ago around second homes, why they saw more inventory. I do think you're going to see that because where you're located is very close to the tech industries of the world, right? Silicon Valley is right down the road from you. A lot of people aren't getting the same bonuses they got in the last couple of years. A lot of people aren't getting the same stock options. And if they do get stock options, those stocks are lower than a few years ago. So that normally has a ripple effect in those outlying second home areas where people have normally had a nice second home where they don't need to count on rent income to manage and maintain that. And I think that's changing as people are kind of tightening their budgets. So second home markets, I do think are going to be softer. A lot of people are also retiring in Sonoma County. Some of my family has a second home in Sebastopol, which is near you. And that's a little small town and not a lot of building going on. So I would say just keep your eyes out, look for things that are available, and make sure you make the good long-term decision. And that's the big thing. Your goals are different than my goals versus the other fine gentleman next to me on the call. But but just I would just think about long-term planning. And if things go down significantly, to me, does not mean like a 50% correction, right? As values go down in surrounding areas, it's more likely people are willing to move to those areas because it's cheaper to drive an extra 10, 15 minutes than it is to live in those congested areas. So, there are trade-offs. As values change, they have indirect and direct effects of other competitive markets in the area. What's an extra 10-minute drive? That kind of stuff, closer or farther. Those are some things to think about.
Definitely. It's a lifestyle decision, right?
Yes.
Orlando, I can't remember if I said thank you or not. So thank you very much for the donation. And Crystal says you have a great YouTube channel. So I'll have to check out your YouTube channel, Orlando. Appreciate you. Thanks, Renee. Renee's a longtime subscriber as well. I appreciate you. Thanks for joining me on the call or video. Same with you, Crystal. Appreciate you. All right. Let's see what else we have here. Hey, Jason, I see Orlando Miner is here. I thought you guys should do a live. Okay. I do not watch, if he does housing market videos, I do not watch other videos of housing market. I spend so much time researching the market that I want to watch supercars and bike racing on my spare time. So I'll take a look at his channel, Orlando Miner. Awesome. All right. Does your outlook on the housing market take into account rises in unemployment? At least 4 businesses in my area are closing. A lot of companies are seeing declining sales. In my personal opinion, yeah, that's something that's going to be something we should be paying attention to, is a potential rise in unemployment as we see these lagging effects of the Fed increasing rates, and that could impact the housing market. I was just talking to it was my dad actually the other day, saying how if I lost my job, I wasn't earning any money, I had no savings, I had credit card bills, I have a lot of equity in my house, so I could just move and rent it, or I could sell it. So there might be a scenario where I always talk on the channel about how, because people have rates at 3%, 4%, why are they going to sell? But there's also a scenario too where people would opt to sell because they need funds, because they lost their job, they're having a financial hardship. So I can also see that happening as well. I also can envision a scenario too where if we get into a recession in the second half this year, potentially, and we have a lot of people who are losing their jobs, I also can envision a scenario too where the government's stepping in again and expanding the mortgage loan forbearance program, for example. So I also can see that as well, where maybe some potential government support comes in, which would further cause the supply to remain at low levels as well. So hard to say.
I
what do
got
you want to add?
this for you real quick too, Jason. I'm seeing migration patterns. So I lend, like I said, in 31 states. I've seen where the migration patterns are. So like Jason mentioned, he may move to a different part of the country if it's a better way of life for his needs, right? People are going to be moving around more often than moving down the street. A lot of migration patterns away from California, still to Texas, Colorado, Arizona, Nevada, Tennessee. You're seeing migration patterns happen because people can't afford to live in their area, or their family can't afford to live in the area. So I'm hearing a lot of people moving closer to their grandkids is a lot of the stories I hear a lot. And all that means to me when I hear that is, unfortunately, my kids can no longer live in the area that they were raised. And now I have to pick up and move to see them and be near them to have a better quality of life and be involved with their lives. So I think you're going to see migration patterns change. And, we know with COVID, the experiment kind of worked. You can kind of work semi-remotely in certain industries. So I know people are being called back to the office, but, there's going to be a lot of people moving around. So those businesses you mentioned, by the way, Cubicle Investor, are probably people that are smaller businesses that probably had lines of credit halted or changed because their banks may have gotten in trouble also. Maybe their banks are having issues. So the ripple effect from banks having concerns to lend to support local community companies, or the Amazons of the world coming on, line and taking over some of that business, all those things are happening simultaneously. So we'll see how that affects your area specifically. And I don't know where that is, but I hope things go okay with your with those businesses in your area, and that everything's okay. So
Absolutely. 138 people watching, only 22 thumbs up. Jay, is a friendly reminder to hit the like button. We actually have 159 people still watching. It's been pretty steady at that. So thanks very much for joining, everyone. And you're very welcome. Do we touch on this? Do you all see Fannie and Freddie putting out DTI ceilings for lenders ever? I don't think we touched on that.
They do have those limits. Yeah, they do have limits. Fannie and Freddie are under conservatorship, which means the government took them over because they were failing. They still have them under conservatorship, which means they're still kind of babysitting them in a way. Those loans, that's a nice way of saying it.
Yeah, it is.
So FHA, Freddie Mac, and Fannie Mae are kind of all run under the same organization, which is HFHA. And what you'll see is that they all have different niches that they focus in on. So under those DTI, or debt to income ratio ceilings, they actually go higher for first-time home buyers. And a first-time home buyer for many of them is defined as someone who hasn't owned a property in 3 years. Doesn't mean you have never owned a property. It just means in the last 3 years.
Wow.
So there's a lot of people on this chat right now that probably don't realize they may be considered first-time home buyers, even though they maybe owned a house 10 years ago. So be aware, each situation is different, and don't move to Texas. All right. Either you're trying to keep us away because it's awesome, or you had a bad experience. I'm not sure which one, but I was in Austin last week also for a work event too. So anyways, two for two.
Kevin and Wing, thanks very much for joining. Appreciate you. Renee has a good question too about Airbnbs. With Airbnbs being hit by travels reducing their expectations and a slowdown in home buyers moving to other parts of the country, how do you see this affecting potential Airbnb sales?
I have a good
Airbnb
answer
sales. So okay. Go ahead.
I have a good answer to that. So Airbnbs are regulated per city, per county. Airbnb is kind of like Uber coming in and it's a disruptor.
Yeah.
Certain communities are okay with Airbnb and certain communities cannot stand Airbnb. So I would do my homework and do due diligence to stay up to date on Airbnb changes in your specific area, because that is an opportunity at times, and that's also a very big risk at times. For example, in Santa Cruz, where I live, there's only about 200 permits allowed in the city of Santa Cruz for Airbnbs. 200 out of like
total or new ones each year?
Total.
Wow.
So
that's crazy.
They don't transfer. You can't transfer when you sell the property.
Wow.
So you're truly not sure if you're going to get a permit or not, or how long it's going to take to get a permit. So do your homework in your specific town. Sometimes it's even as a regulation, like within 150 feet, if there's not another Airbnb, you can do it. There's really funky things per county and per city, and I would definitely study those. That to me is the biggest threat and opportunity to that investor pool. Really learn where those changes are happening, because if you can't Airbnb and property out, those cash flows are much lower for a traditional longer term renter. And it's a different kind of investment altogether. So great question, Renee. Do your homework. If you have an area that you're living in California or somewhere else, let us know. We're happy to look it up and help you try to find the right resources.
Yeah, thanks for the question, Renee. And Mark says, yeah, cost of ADU, 749 square feet ADU, minimum $265,000. I mean, that's absolutely insane. I don't know if, Mark, you're the one who emailed me about this. 265,000, I'm just doing my dumb math here. 749 square feet. That is a whopping $354 per square foot. This is why they pass these laws saying how you can have like 2 duplexes on your property and build an ADU. This is going to help housing affordability. How is that helping housing affordability? No one's going to do that. It's crazy. All right, what else we got here? Who is still funding Rocket Mortgage, B of A? Question mark.
Who is still funding Rock? So there's two channels in our industry for mortgages. There's retail, which means if you walk into a B of A branch, you may get great service, you make great rates. The more the fastest growing channel is the wholesale channel, where companies like Rocket Mortgage, United Wholesale Mortgage, and other lenders are aggregating loans and they're putting them together and selling them to the government. That is called wholesale lending or correspondent lending. You have two channels there. So your question, ironically, covers those two channels. B of A is a direct lender, so they're really good at certain things. And companies like Rocket Mortgage and UWM, United Wholesale Mortgage, offer a lot more variety. So it just depends on your circumstances. B of A is a portfolio lender. That means they lend sometimes their own money. Rocket Mortgage and UWM they fund the loan, but then they sell off the loan. So each one's different, and at certain times of the month and day and year, one can be better than the other. So work with someone who knows those differences and can work with both, or has the ability to decipher what's the best for you.
Good question, or good response here. Growing Up Gaming, also been a long time subscriber. Appreciate you. And yeah, absolutely. I appreciate the kind words. Thank you so much.
What a fine gentleman you are. Fine gentleman.
Fine gentleman. Yeah. I haven't really looked too much at the this market. Jimbo, I assume you probably don't know much about that. The only thing I do know about that market in Florida is that Redfin every week talks about the cities in which they have the biggest increases in prices, and Fort Lauderdale, Florida, is one of the number one spot, maybe number two spot nationwide, where one of the only markets where prices are still up by double digits. The last time I read was like 10%.
I have an idea for you. So every day there are 10,000 baby boomers that retire every day, every single day of the year. Those people probably are downsizing or want to live a more comfortable life. Maybe they live in the upper East Coast area where the weather is not always the best. Maybe they live in a 2-story home or have steps, or want to be in a more senior focused area where they have more consistent weather or conditions, or maybe just the quality of life is different. So I think you have an influx of that baby boomer demand there that's coming into that market, because that's, again, a huge influence. The millennials and the baby boomers are the two big classes of people that are making moves. Millennials, there's 12 million new millennial households that have been formed in the past 10 years, which is huge, the biggest class of people. And we're seeing the wealth transfer, not of the actual transfer of wealth, but the actual knowledge and decision-making go from the baby boomers to the millennials, skipping the rest of the people in between, the Gen X, Gen Y people. So you're going to see in the next 5 years, in my opinion, the decisions are going to be made by the millennials for their families' wealth, for the older families, because just the transfer of knowledge, the fact that there's no longer personal bankers, you can walk in at your local bank branch and visit and educate. So you're going to see a lot of that change. But I think the baby boomers are really important to follow. They have most of the wealth today, so where they go probably keeps values consistent or stable across different markets.
Yeah. What's a funny comment I get on the channel pretty frequently is that the baby boomers are going to crash the housing market. And it's like my response was like, are they all going to die in the same day? So it's like, I don't understand that. There has to be other videos out there talking about this or something, but it's, just because someone passes away doesn't mean their house is going to sell. You could have their heirs move in, they can rent it out. And obviously there's not going to be like this, everyone dies within a month. And so they're just going to flood the inventory, flood the market. So yeah, I don't understand that philosophy. Renee has a good question. Will we see more bank failures? How does this and our debt ceiling impact the U.S. housing market? I think that with a lot of the roadblocks that's been hitting with this debt ceiling impact and not coming to a resolution, that's also driving rates to increase this week as well, if I'm not mistaken, Mr. Jim Black.
No, I agree. And again, bank failures are not a good thing. We want more competition, right? competition normally means better pricing, options for the consumer. We want the consumer to have a lot of choices in what they decide to do. Choices means better rates and better prices. So if the debt ceiling does not get passed, they do say there's something like a chance that the markets and financial markets could go down up to 40 to 45%. That's substantial. That is a deep recession if that happens. But you're going to see more regional banks still have issues. Those regional banks that will have issues have a lot of commercial debt. Commercial debt is people that have office building debt. Maybe they have a loan on a high rise or some other type of property. Those loans are coming due in 2027. So a lot of those loans are coming down the road, and they're going to have a lot of high debt payments because those rates are at 4% today, and those adjusted today, they'd be at 8%. And you can't go back to a business overnight and say, Jason, realtor, your office space, I'm increasing rent double tomorrow. Jason, the realtor, will have an opportunity to go rent somewhere else. So that's the issue at hand, is that banks are preparing for some of the things that may come depending on their balance of their investments and where their risk is in their portfolio of assets and liabilities. So just know that there will be other banks that have issues. JP Morgan Chase, B of A, Wells Fargo, Citibank, those are all very, very solid names. There's no way the government would allow the Bank of America, just the perception of that alone, to have any really big issues, right? Because people in other parts of the country or world believe that Bank of America is the bank owned by America. And it's,
Are you serious?
It's symbolism. Yeah, it's symbolism to the world, right? Stabilization, American dream, the dollar. Everyone wants to strengthen the dollar. So I do think we're going to see some more, Renee, but I don't think it's going to be systematic, excuse me. And I think it'll be highly concentrated in areas that are not lending to real estate, residential properties right now. It's going to be weird commercial focused companies, people that have Bitcoin and all kinds of those other cryptocurrency investments, high flying growth stocks, things that you and I wouldn't see every day. So.
Yeah, definitely. Yeah, it's not going to be like a JP Morgan or whatever. Jeff's also a longtime subscriber. I appreciate you, man. Thanks for joining on. I think we answered Rebecca's question there too. You basically just touched on that as well. Rusty Riggs said locked in 180 days. That's impressive to be locked in that long at 6.375 in March.
Congratulations.
Yeah.
And hopefully
considering the rates are at 7% today, that's for sure.
Hopefully your loan closes at day 179, not 181. So I'll be rooting for you there for the 179. So anyways.
Definitely. Victor Ashley Real Estate. Hey, Jason, can you speak about rent to mortgage ratio? Some areas in Seattle, Washington, mortgages are 180% of rental cost. Holy cow. Quite the jump in monthly cost. I do not know much about this ratio at all. Is this something that you're in your wheelhouse, Jimbo?
You could just say, basically, simply put, that if I'm reading this question correctly, that it's less affordable to buy than it is to go rent. That rents are easier to find in a specific market than properties. So that means that there's a lot of corporate-owned entity properties, probably a lot of multifamily, high rises, and that type of stuff, where it's in lockdown. You can't buy those units. So I think that's what that refers to. Chicago has the same kind of issue where you have a lot of condos and a lot of high rises, and a lot of people aren't living in those places. So rental costs are a lot lower in those areas relative to buying. So in your case, Victor Ashley Real Estate, you have to think about, is it worth buying if you're going to save 187? If that delta is that big, if it costs you that much more to own, just say you own, it might not be worth owning in that specific market. Maybe you go buy investment property somewhere else, and that helps you make a better investment. So
yeah, I understand that now. Okay, yeah, they're saying that their mortgage payment would be 187% of rental costs. That's a giant increase. I mean, I
wouldn't recommend that unless you're hitting the lottery tomorrow. Then that's okay. But
if money doesn't matter, then go for it. Yeah,
hold off on that decision. Yeah.
Thanks for the clarification on that, Jim. You're spot on. Thanks for the regular content and data-driven analytics. Super appreciate it. I appreciate you, Audrey. Thank you for that. Thank you so much. Jim, how much time do you have? It's 4:45.
I have a 3 and 6-year-old, so I got as much time as you want, my friend.
Let me call my wife too.
Like...
I have a 1-year-old and a 3-year-old, so this might last until, I'm guessing, like maybe we should call our wives till 10 p.m.
I think we should do is live on a plane, and we'll go fly to Hawaii and talk to one of your other guests, right? The one that's in Oahu. We'll go there and we'll keep this going. Let's just if we get enough donations, we can do it. Let's do it.
Yeah. And our wives know where we are. They can just like look on YouTube. They know we're not up to anything bad.
Yeah. We're just talking. Yeah. Two fine gentlemen. Anyways.
2 fine gentlemen. Yeah. That's so funny. Oh man. It's hilarious. Thanks guys. You're very welcome, John. Answered your question a long time ago. Hello from Chicago. Yeah. Orlando, longtime subscriber of mine. Yeah. Approving 55% of gross. That's like, it was net. That's a different story, but holy cow, gross. That's just insanity.
One of the things I always talk about is just because you can or because they approve you doesn't mean you should. So a lot of times people make that decision of not knowing that they, should maybe not be buying something, or maybe not, maybe hold off. Sometimes the best thing you can hear is, you know what, it's not the right time to do this. Let's plan ahead and get you to that right time and wait. And that's something that a lot of people need to hear. And it's okay to be patient. It's okay to wait. If it's not the right time, it's not the right time. So
yeah, I hear you. Absolutely. I would say if you're someone asking that question, should I buy or should I buy now or wait? Is if you're over leveraging yourself and you're getting to a payment you're really not comfortable with, then gosh, that's risky in my opinion. Johnny Fly, good to see you, buddy. I'm wondering what Jason's favorite restaurant is in Sacramento. I'm super judgmental. Well, adding that little bit at the end, I mean, now I'm like nervous. What do I say?
Be really careful in this. This one might be different. Yeah.
I have to say I'm a big fan of Mexican food. So like, what's it called? Chipotle's. I love it. Burritos. I mean, you can't go wrong with a burrito. And there's also Mas Taco. Love that place. For sushi, my wife and I love Crew and Midtown Sushi. There's a lot of favorites we have.
I like Frank Fat's. Frank Fat's,
oh yeah,
favorites. Dim sum, modern Chinese food. Is Banderos still open?
Banderas is gone now. Yeah, it's a new company now. Anyways, they're no longer. Yeah. But yeah, Frank Fat's is great. I mean, there's a lot of good restaurants in Sacramento. And feel free to judge away.
I'm getting hungry now.
I'll give you a wide variety. Jim grew up in Sacramento too, so he knows a lot of the restaurants here, but he hasn't been here in a while.
In a little while, yep.
John says, I was planning on paying cash for a home. I'll buy a house.
Okay, that's a bad idea. Bad idea, my friend. So there's a term, and I'm not a CPA. Jason actually is a CPA, so he can.
I have never worked in tax, though. I'm not going to give anyone tax or financial advice.
All right, so John, here's the answer to your question, which is, should I pay cash for a property? And I'm, again, not a CPA, so please talk to your professionals that you trust. There's a code that's known as the acquisition indebtedness. That's INDEBTNESS, indebtedness. It states something like this: whenever you acquire a property, whatever loans you have on that property at the start of that acquisition, normally 90 days or so, those can be deductible for the life of ownership. So again, I'm not a tax guy, so talk to your CPA. But if you were to pay all cash, and then 2 years from now decide you want to take cash out and you're retired and you're on a fixed income, you don't get to deduct that mortgage interest at all. Each state's different for that, obviously. So mortgage interest deductions are different state to state and federally. But if you pay cash for something and you don't put a loan on it, you don't get to write off that interest if you ever were to take out money down the road. So whatever debt you start with is the acquisition indebtedness that you can deduct mortgage interest from for the life of that loan, for the life of that term. So be aware of that. A lot of people go in and do all cash and don't realize they can't go get a loan later and write off that interest. And that's a big deduction for some people, especially if you're fixed income. That could be a benefit for you.
Yeah. With the increase in the standard deduction, though, I know a lot of people who don't are not able, or not, it doesn't make sense for them to itemize too, right?
But in California it's really bad. But in other states they're a lot more flexible.
Hmm.
So I would make sure that I think about the opportunity cost on getting a loan versus paying all cash, and the opportunity cost on that investment. Can I make more money in some other investment long term than
Yeah.
having an interest rate on a loan of 7.5%? I don't know, but that's just something to be aware of and think about and make sure you've evaluated. So.
Yeah, absolutely. Steve, yeah, I'm a big fan of supercars. Love going to car shows, Monterey Car Week. Absolutely love that stuff. I don't know anything about them really, but I like the looks of them and sounds of them.
You used to have a supercar in high school. I remember that.
Oh man, Black Death.
Yes. Yeah.
I had a, what was that? Plymouth Laser back in like when I was 18 or something like that.
I
All-wheel
forget.
drive. I destroyed that thing.
Not safe.
Do not buy your kid a fast car. I can't believe I'm still alive today. Went 147 miles per hour down I-5. And our buddies are filming the back seat.
That is not
Stupidity.
a right there. That is
Do
not.
not do that. Yeah. Please provide your insights for the Bay Area real estate. This is a perfect one for you, Jim. I know that I've been reporting how prices in the Bay Area as a whole have been going down greatly compared to April, May last year, but then prices are starting to go up again. I need to make my video I make every month about that. So stay tuned for that. But Jim,
Sure.
you live in the Bay Area, or kind of the Bay Area.
So yeah, so it's what's been sad to see. San Francisco is pretty sad right now with a lot of the issues around homeless and violence and all that stuff. People have not been going back to move to San Francisco. They've been moving outside of the areas. And ironically, a lot of people are moving from the Bay Area to Sacramento. They call it Silicon Valley East, right, Jason? Isn't it Silicon Valley?
I don't know about that. But we've helped a lot of people move from the Bay Area over the past several years, and helping a couple of people right now. Yeah, there's a lot of people moving here because they work from home. You know, why are they going to live in your 1-bedroom apartment and pay $4,000 a month for it? You buy a home for cheaper than that in Sacramento.
Yep. So back to your question, Uber sold at 04. Basically, I think you're going to see higher end houses in the Bay Area probably take a hit. Again, those people that were getting paid a lot of money in the stock options and RSU income, which is all variable compensation. Remember, Apple, Facebook, LinkedIn, Google, all these companies like to give about 35% of their guaranteed income in the form of salaries. The rest of it comes in the form of variable comp based on the performance of the company and the markets. Those companies are smart. They give a lot more upside, but then they don't have to pay a lot of downside on things also. So that's important to be aware of. So I believe people are going to adjust downwards on their expectations. Ironically, I'm helping someone right now with a $9 million loan, which is kind of crazy. So kind of weird. So things happen all the time. People have life events. They have different goals. But I think the Bay Area on the higher end stuff is in for a challenge, especially because a lot of people can't move back here to be closer to their parents, right? They've moved to Austin, Texas. They've moved to other parts of the country. And so those families are realizing that they could sell their big asset and maybe get 3 or 4 homes in other parts of the country and enjoy life. So I think you're going to see softening on high-end stuff. And then there's going to be ultra rich people doing weird things too that don't have to worry about money. So you'll have some markets that just doesn't matter. They're not affected by it. But I would say the move up market to the middle market to the higher end market will have a direct effect in the near future.
Yeah. There's some talks too about how the bank failures is going to be causing a tightening of lending standards, especially for jumbo loans. So is that true? And if so, I mean, one would assume that would impact the Bay Area because prices are there tend to be a lot more than the jumbo limits. So it's like, over $1 million for a loan is a jumbo, right? So are you seeing that as well?
Absolutely. 2 of the high jumbo net worth banks that supplied a lot of those loans, First Republic Bank and Silicon Valley Bank, are no longer in existence. Mm-hmm. First Republic Bank dominated the higher end jumbo market with a lot of relationship products, which is great for their clients, right? They got a good deal, but that's all gone now. So you are seeing less and less choice, less and less variety, less competition, which means if banks have less competition, they're not in the business to be a charity. They're in it to make the most interest. So they're going to raise their rates effectively to the highest point they can where they don't lose demand. So it's not like the opposite where they keep lowering it. They're going to raise it till that demand is to a level where they can use all their supply and get the maximum return. So I do think you'll see higher prices on jumbo financing because less lenders are lending.
Yeah. So that with the variable compensation could really impact the Bay Area housing market.
Yep.
Makes sense. Moses, thanks very much. Smash the like button. Appreciate you. Steve-O, hit the like button. Appreciate you guys. Let's see. Let's answer a few more questions. We'll wrap this up. We don't want our wives to be mad at us. I don't see them in the chat though, so I think we're okay, right, Jim? Is that how it works?
Yeah, this is coffee, by the way. I'm drinking coffee, so we're good.
Sure it is.
It is.
And you talked about your crystal ball with rates end of the year. Yeah, I guess you're seeing how rates you envision them. They're probably going to be lower. I think you said next year, but yeah, end of the year. What's your forecast, Jim?
I think they'll be lower than today's rates by about a quarter. So I think we go higher by about a quarter in the next couple of months. And I see a shift of about 0.5% lower by the end of the year. It's all going to depend on the employment numbers and that confidence factor, right? If employment numbers start to turn to the lower side, one thing about the economic data that the government provides, they don't decipher between a job loss of a high wage earner or a low wage earner. It's the same for them. So if someone working at Facebook in the Bay Area that makes 10 times the amount of someone working in some part of the country, they don't factor for that. So if a Facebook job's lost, in this example, that's 10 jobs. So they don't count that the way they should count that.
Interesting.
That's a big thing that we're seeing, right? A lot of these jobs they're leaving these jobs and technical jobs. If a technical job goes away, someone can't be a programmer in a highly complex programming code at one company that's no longer in business. They don't just shift and get a job tomorrow. It takes them several years to retrain if they want to really get back in that same field. So be aware that some of those jobs here in the Bay Area, for example, are highly technical jobs. If they go away, those people are going to have a hard time finding another job. So I do believe rates are going to go lower in the next year. So you guys need a loan officer? You guys hiring? Sure.
I think it's for you.
Yeah, come on the plane. Jason's just loading us up. We're going to Hawaii, and you're welcome. Yeah, we're growing across the country. My team, I'm really lucky to have a great team around me. We are growing, and so yeah, reach out if that's a serious question. If not, totally cool too. But we're starting a new company called Fine Men's Real Estate Group. So we'll be doing a lot of nice stuff. Anyways,
awesome.
Fine gentlemen.
Sacramento here. All right, MVP Sports. Yeah, affordability is worse it's ever been. Yeah, I made a video about that because I saw a YouTube short or something saying how, it's a great time to buy because it's cheaper now, or it's cheaper now to buy because prices are down compared to a year ago. When you actually look at the data though, your monthly housing payment is actually higher now compared to a year ago, even though prices are down. That's because rates have increased so much. Yeah, that's an interesting concept here. Chipotle. What's wrong with Chipotle? I love Chipotle. And now I'm going to get some flack with that. Any like Mexican restaurant, I love Chipotle. It's so good. Chipotle. Yeah, Zocalo is way good. I love Zocalo. I haven't been there in a while though. We spent a lot of our time at home eating with the kids. Oh, awesome. Roseville. I'm just a half an hour away. Frank Fats in Folsom. Okay.
There you go, Steve-O. All right. That's
where do you guys live now? I'm in Sacramento. Jimbo is in Santa Cruz area. Let's see if there's anything else.
Does Paradise live in Paradise? Is that just
he must. I mean, it looks like a good place to live right there.
Yeah.
I wouldn't mind living there. Looks like the Dominican Republic, but who knows? So now a good time to lowball offer.
Why not? Why not? Yeah, why not?
Yeah, why not? I would say it's a complete waste of time if you're writing an offer. If the listing's for $1 million, why are you going to write an offer for $500,000, right? So I think it depends on days in the market. Let me give you guys an example, and we'll kind of wrap this up here. And I'll see if there's any more questions here. we're doing our best to try and answer all the questions here. So we got an offer accepted for a client maybe 3 months ago. This house is in the market for 135 days, listed for way too high, no price reductions. So in that scenario, it's dead on the internet. No one's looking at it. No one's going to be looking at it, going and doing showings because it's been listed for sale for so long. So we wrote an offer. I think what asking was like 850. We wrote an offer for like 760, something like that. And they countered, and we came back and settled at, I think it was 787,000 off of like 850. So a big discount off the original asking price. So you can do that on a stale listing in general, because they don't have any offers. There's no competition. If it's a brand new listing, especially if it's priced right or even priced aggressively where it's priced below market value, then, good luck with that. So I would say it depends on how long it's been in the market for. Anything you want to add to that?
No, just, yeah, I mean, within reason. Yeah. Because if you live in a community, especially a small community, you gotta be careful on how you approach that, because you don't want to make everyone upset, because then you won't get another opportunity.
I haven't thought about that.
Realtors are big on their reputation also. Same with lenders. These people work hard in the communities. So if it's just out of the ballpark crazy, then they're probably not going to do it. But realtors have to be careful, because they're going to work with these people again down the road. So they're representing you, but they're also representing their own brand, which I respect. You guys are all self-employed, and it's not easy. So thank you for your hard work, Jason, and any other realtors on this call. So
yeah, absolutely. We gotta get a video. I wonder what that video is. My buddy filmed it in the back. The stupid thing.
Was I in that?
Do not drive
I was in the other car. I was in the other car where there was white smoke coming out of the Toyota
Camry.
Yeah, that was that one. Yeah, I was in that one. That was not good. Not good either.
That was not good. Yeah. Yeah, exotics at Broadway during Car Week. I mean, Car Week's awesome in Santa Cruz, in Carmel area. Are you licensed in Montana, Jim?
We do have resources. Yes, we are licensed.
Okay, cool. Program here in the Bay Area. You guys are overrating us. Most of the time, our meetings are watching YouTube videos. That's funny. No, I hear you. There's a place in SoCal in Redondo Beach where they have French fries in their burritos, which I don't know. That's not real Mexican, but it's delicious. There's tons of really good Mexican restaurants in Sacramento. Thanks for Crystal for joining on. Let me see if there's anything else here that we want to touch on here. Andy's what they do. All right, I think we'll wrap this up here.
Sounds great.
Yeah. I think our wives need our help at home with our young ones.
Hey, babe. Yeah, we're going to be in there. We're going to be there 4 hours. Yep, 4 more hours. It's a long one. I'm trying to help Jason out, I'm on his live podcast, babe. You're hearing this. I can't talk right now. I got to go 4 hours. Bye. I love you.
Life of having 2 young ones. Thank you, everyone, for joining us in today's video. And Jim, thank you for your time and expertise. Love to have you on the channel again. I appreciate you, man. And everyone has any additional questions, we'll have this video on my YouTube channel. I'll also link Jim's YouTube channel as well. If you guys missed my video I posted, I shared it. I did a podcast with Jim. Your podcast is Know Before You Owe, right?
Yep, Know Before You Owe, and it's on Spotify, Apple, and YouTube. And we want to help people make good decisions before they make those decisions. And a lot of things in life, like we all have experiences, and if you can learn from other people and help that guide your decision that's right for you, then that's kind of what life's about. So we have some good guests on there, and I had Jason on. It was a fantastic episode, and appreciate all you guys watching today and participating, and let's do this again for sure.
Absolutely. Yeah. Thanks everyone for joining again, and we'll see you on the next video. And thanks again, Jim, for joining, and we'll talk to you soon. Have a great day, everyone.